Hello friends, today we are going to discuss about Basel 1 and Basel 2. So let's start. So my first question would be here, because Basel basically deals with risk, with banking risk, obviously. So my first question is, what is your perception of risk, or how do you define a risk? So as we can see there, risk is the potential of gaining or losing something of value. So this basically deals, risk basically deals with the uncertainty that we see. Now let us take an example. Say we have invested $100 in an equity fund. Take the probability of appreciation is, there is a probability of 20% appreciation chances in the next 1 year, and there is another chance of losing 30% of the investment in the next 1 year. So you can see there is two probabilities here. Maybe we'll take it as 50% for the sake of the this session. So 50% chances of 20% gain, and 50% chances of 30% loss. Now if we take a prudent approach, so what is our main concern over here, or what is more alarming to us? Obviously I think that 30% loss, right? If we gain 20%, that is all the more merrier for us. But then the concern or the alarming fact is that we might lose 30% of our investment. So that is where the risk we are more concerned about. So my point is that risk can be upside risk, there can be a downside risk. So we're not really worried about the upside risk. That uncertainty, we are pretty much going to welcome any such kind of risk, but we are more concerned, or we are primarily concerned with the downside risk. And that is what we are going to discuss here, and that is what Basel is all about, dealing with the downside risk for banks. Now when it comes to banks, they face a plethora of risk in conducting their business. So few of the risk kinds can be credit risk, liquidity risk, market risk, operational risk, reputational risk, and macroeconomic risk. These are the few of the risk kinds. There can be more number of risk than this. So when you talk about credit risk, it's basically whether the obligor will honor his payments, whether he'll be making the payments on time. So that is the credit risk. And when we talk about the liquidity risk, say we have a collateral or whatever instrument we have. So what is the marketability of that instrument? It is like when you go to the market to sell that instrument, so how quickly can we sell it, and what is the kind of cost that is associated with that sales, so that is what is liquidity risk. So if in case the cost incurred or the associated cost is low, and the instrument can be sold in the market easily, that is very liquid, which is good for the bank. But if in case something which is very rarely traded in the market, so you can imagine finding a buyer for such kind of instrument can be a tough ask. So even the cost that is incurred, because since it is a rare commodity, so you have to maybe to lure buyers, you need to spend more. So that is less liquid, and in such scenario, it's a risk for the banks. Now when you talk about the market risk is basically if you have a portfolio of various kinds of investment, maybe that is into bond investment, equity investment, and options, derivative instruments. So what is the impact of different market movements So I mean, mostly we see uh, market risk associated with interest rate. So how interest rate movement is captured in the bond pricing, and how it impacts the portfolio. I mean, even interest rates do impact the options, and in a way it does. I mean, as bond prices are impacted, even the equity valuations are also impacted. So I mean, interest rate is primarily taken as the very common driver for the market risk. Now when you talk about operational risk, that is primarily with how the bank is able to conduct its business, with the processes and with the people. So that is more of like bank, I mean, firm specific risks, and that is there. And reputational risk is where the bank has, I mean, it can be an impact of various other risks that are mentioned over, like credit risk. If you know, there is a word of mouth in the market that the bank has been dealing with, or has been incurring losses in the current past due to different various defaults. So that can be a hit to the reputation of the bank, or even the market risk. Like the bank had invested a certain amount of money in the market, but however the asset values have gone down drastically in the last couple of months. So this kind of uh, uh, this kind of risk ultimately leads to a reputational risk, where the reputation of the bank is distorted and people tend to lose their confidence in the bank or the bank's operations. So that is there. And macroeconomic risks are basically global, or not really global. It might be regional, specific to some. So, I mean, something which is beyond the capacity of the bank, or it might involve a number of banks. So it can be anything from global to a number of banks, but it is beyond the capacity of the bank. Now the thing comes, how well risks are managed. So in this case, how do you identify, I mean, how do you classify a bank, whether a bank is a good bank or a bad bank? Because risks are there to be, you can't do away with risks. It is there to be, and the best way to to make the people believe in your system or in your operations is to manage the risks properly. So to do that, you need to understand what are the drivers which are really leading to that risk. It is only then, because mitigating those risks, basically it allows you to invest in a more efficient way, and not just that, even the returns that you receive on your investment is much better. So in a way it positively impacts your profitability. So how to differentiate a banks, or how to identify which bank would you like to put your money on? That is basically determined by the fact how the banks deal with the or mitigate the risks. Now with that came the existence of Basel Committee. So Basel Committee is a global standard setter. So Basel, like I mentioned over here, Basel Committee on Banking Supervision. So going forward, we'll term it as BCBS. So BCBS basically sets the prudential regulation and standards for banks across the globe. Now its objective is to hello. Yeah, like I said, Basel's objective is to make sure that the banks across the globe follow the same rules and regulations, because it's very difficult for all the regions or the central banks to follow same set of rules, unless and until there is a supervisory body which is there to provide you a common ground to play. I mean, it's basically making easier for all the banks to follow a common set of rules. So and its primary objective is to make financial stability across the globe. So with that in the perspective, Basel Accords came into play. So when you talk about Basel Accords, it basically refers to the banking supervision accords, that is Basel 1, Basel 2 and Basel 3. So these are the supervisory accords which were introduced to capture risk, to quantify risk, and to make sure that banks across the globe follow the same rules for that. Now we'll move to Basel 1. So what exactly is covered under Basel 1? So Basel 1 came into existence in the year 1988, and when we talk about Basel 1, it focused almost entirely on credit risk, and it included the risk of counterparty failure. And what it did is that it defined, or it classified the bank assets into five categories according to their credit quality. And the various I provided you with a table. These are just examples of those categories. It's not entirely exhaustive list of that. So if you can see, there were instruments like cash, bullion, home country debt, so wherein you can see the liquidity is very high. If you think about cash, there is nothing to convert, so it's basically you are having cash in your hand. So for that you don't need any risk, so there is no liquidity risk, nothing. You can easily that is already a cash. And also bullion or home country debt. So here you have to see home country debt. The thing is that it's basically talking about the treasury bonds of the government. So here the idea is that even if the banks within a country might fail, the sovereign or the country is there to rescue it. So when you talk about debts to the country, that is taken as a safe haven for them. So that is the reason you can see the risk weight to be zero. So that is the idea behind that. So this category 1 is basically very liquid assets, and the cost of conversion is very, very low, so the risk weight given to that is zero. Now when you come to the second category, that is securitizations such as MBS, and with the highest rating. So for example, you can take the highest rating to be, say, AAA rated entity, MBS, mortgage backed securities. So in that case, given a highest rated securitization, you can expect that as far as the liquidity is concerned, it should be very easily marketable. Yes, and given the highest rating, so the credit quality is very high, so you don't expect these entities to default. And so in that respect, the risk weight that is taken is 20%. So if the total lending for a securitization assets are maybe 100 billion, so the risk weighted asset would be around 20 billion USD. Now the next category is of municipal revenue bonds. So here again, these are government revenue bonds, but slightly lower on the ladder. So maybe in this case the credibility is slightly lower, and as such they've assigned a higher risk weight of 50%. Now when it comes to corporate bonds, these are basically a prudent approach. They they want to take 100% risk weight on this, so whatever they lend, they take it as a risk weight. I mean, they take it to be a risky lending. So here they have taken as 100% of risk weight. Now the fifth category is where they don't have any rating for the entities. So this is something which is a gray area. You don't know what is the kind of risk in this, and this does create a hazy picture. You don't know whether it might be 200%. I mean, the risk might be pretty high. So that is there. This is a, you can say, a shortfall of this risk weighting table. Fine. So this was basically Basel 1 risk weighted asset process, and based on this, the risk weighted asset was calculated, and then when it came to the capital calculation, it was basically the 8% of whatever summation we used to arrive from calculating the various assets over here. So that would be the capital requirement under Basel 1. Now if we move to Basel 2, now Basel 2 came into existence in the year 2008, and if we think about what is the primary difference with Basel 1, Basel 2 is assumed to be more risk sensitive with its capital allocation, because even within credit risk they are having various other classification and more granular attention towards the risk categorization. So that is there, and also they've included in this the market risk and operational risk. So that makes it more more focused, because prior to this, Basel 1 also had few parts of the market risk captured into those capital requirement, but it never had that kind of focus on market risk and operational risk. But it under Basel 2 it was much better. Now when you talk about Basel 2, Basel 2 has 3 pillars under it. The first is the minimum capital requirement. So when you talk about the minimum capital requirement, it's basically what I've been telling you regarding that risk weighted assets are calculated, and then the capital requirement is 8% of that risk weighted assets. So that is what basically comes under minimum capital requirement. That is the first pillar. And then comes the supervisory review. Now when you talk about supervisory review, it includes various other calculation which is beyond that minimum capital requirement. Like you can take there is a concept of economic capital. Now when you talk about economic capital, this is where the bank takes into account the concentration. Economic capital, you can say, is an internal capital requirement for the bank, not an internal capital requirement or internal regulatory capital calculation for the bank. When we talk about minimum capital requirement, that is what the regulators ask you to put on hold as a mandate. But when you talk about the economic capital, that is what the bank itself has come up with. And when it does a calculation of economic capital, it basically takes into account the entire bank's assets, its granularity, how concentrated it is in one kind of asset. So that is captured in a better way. And so what is expected is that economic capital is actually the true picture of a bank's capital requirement. But then a bank has to be credible enough such that the economic capital can be trusted. But if such is the scenario where you can see a bank calculates that the economic capital is lower than the regulatory capital, then you must understand that the bank is in a much stronger position. So that is one kind of metric. So what I'm telling is that supervisory review has certain other metrics which are certain other numbers which gives the analysts, the investors, a deeper understanding of how comfortable the bank sits as far as the capital requirement or its risk management is concerned. So that is under the supervisory review. Now when you talk about the market discipline or the market disclosure, which is the third pillar, so under this the banks actually disclose how are they coming at those risk capital requirement, how they are calculating their risks, what are the processes, what are the procedures. So this gives a deeper understanding to the again, like the analysts and the investors who want to dig deep into the bank's process to understand, whether the risk that they're capturing, whether this is in line with their risk appetite or not, or whether the process that or the the variables that they're considering, whether that is the right sort, at least in line with their expectations. So this is where Basel 3 creates more transparency compared to Basel 2. So this is how it differs. So I hope I've given you a fair bit of idea. Thanks a lot. Bye bye.